What's happened over the last decade and a half is a lot of folks have promoted what I call inchoate fears. So notice when they talk about you need to do Roth conversions, RMDs are really, really bad, IRMA's bad, widow's tax trap. Ask yourself, the first question you should ask yourself is, where are the numbers, right? And my experience in viewing and reading personal finance content is a lot of times folks will say, oh, these RMDs are going to be terrible, or you need to do Roth conversions. But they don't back it up with any sort of numbers or only very limited numbers. So I think that's an interesting observation. And what it promotes is inchoate fears. You know there's something that's not positive, but you don't have a way of measuring it. So boy, it becomes this bigger and bigger and bigger and bigger boogeyman, right? All right, well, let's step back. What tends to be true is most retirees are going to be lightly taxed in retirement. I know that's a contrarian message, but what tends to happen is the Internal Revenue Code, our tax laws, tend to like retirees. Now, is that 100% universally true? Of course not, right? But what tends to happen is the retirees that our tax code does not like tend to be very financially successful later in their retirement. And those retirees are in the best position to bear tax risk, right? So essentially what's going to happen is it might be that if you are very financially successful and you use traditional retirement accounts, you might get to a point in your later years where you're paying a 32% marginal rate on some, certainly not all, some of your required minimum distributions. Well, okay. Can you bear it? Yes. And in fact, that's the best time to bear it, right? If you're paying that 32% when you're working and you got 2 kids, that could be a challenge. If you're paying that when you're 60 and you just retired, well, now you're increasing expenses at the front end of your retirement when you're at more risk for things like sufficiency of returns risk. Sequence of return risk. I'm getting excited and mixing up terminology, but all right, sequence of return risk. Is it a huge thing for well-diversified investors? No. But is it nothing? No. So why have these huge tax expenses at the beginning of retirement if it's at least something to consider? Okay. So then you say, well, all right, I'm hearing all that, Sean, but how does that translate to tactics? And in our drawdown, if I could only give you 4 rules for your drawdown, and that's it, and we can't discuss it ever again, I would give you these 4 rules. Now, there's going to be plenty of divergence and tangents off these 4 rules. But let's start with these as a framework, and then we could talk about tangents. So the first thing is spend the taxable accounts first. The cool thing about taxable accounts is really 2 things. One is basis recovery. So, Bill, you and your wife invest in broad U.S. index funds. Okay, great. And they're in their taxable account. You're going to retire in 3-4 years. Okay. Well, those things are most likely going to grow. So then you get to a retirement year and you say, hey, we need $100,000 to fund the next 6 months of our retirement, just living expenses, travel, food and beverage. Okay. So you go into that mutual fund, you sell $100,000 worth of it. Well, how much of that is your taxable income? Well, we know it's $100,000 less some number, less your historic cost, your so-called basis. So that's a really good way of arranging your affairs because your living expenses are, say, 100, but your taxable income to fund those is some number less than 100 because of basis recovery. But it gets better. All right, but there is a gain. Well, if you can keep your income really low, that income might be taxed federally at 0%. And oh, by the way, you live in Tennessee, so the capital gain will probably not be taxed either, right? So it might be that some or all of that gain is 0% income tax federally. So when we combine basis recovery with the 0% long-term capital gains rate, 2026, by the way, for a married couple filing joint, $98,900. If your income is below that level, all your long-term cap gains go off at 0%. So that's very powerful. So that's the first thing. Spend the taxable accounts first. Second, when the taxable accounts get depleted, switch over to the traditional retirement accounts and you live off those. Okay, well, that's fine. I mean, you're going to create taxable income, but because of our high standard deduction world, that might be very low taxed. You might have some of that go out as what I refer to as a hidden Roth IRA. You take money from the traditional IRA it's offset by the high standard deduction, maybe the senior deduction, and all of a sudden you took money from a traditional retirement account. They say that thing is full of tax, but you paid 0% on a piece of that. That's pretty helpful. So that's our second rule for drawdown. Taxable accounts first, then traditional retirement accounts. Third thing is delay Social Security claiming. Look, if you can't afford to, then take your Social Security. Guess what? You're not going to have tax problems. You might have sufficiency problems, different conversation. But delay Social Security to age 70, particularly for the higher earner or a single person. This increases the future Social Security annually when we're in our 70s and our 80s, provides more stability then. But it frees up your 60s for more tax planning. It could be Roth conversions. It could just be taking traditional retirement account distributions against things like the standard deduction. Either way, that can be very impactful. So that's our third rule, delay Social Security. And then our fourth rule, use our HSA, what I've referred to as PUCB previously, unreimbursed qualified medical expenses, and or Roth accounts strategically and tactically. So what do I mean by this? Take them maybe to fund a new car purchase so you don't go up a tax bracket. Maybe take them when it'll help increase your premium tax credit. You have these tax-free pools, and in the personal finance space, we've focused on building them up, and that's great. But now it's time for us in the personal finance space to start thinking about, well, when do we take those things out? Everybody loves to have $1 billion in a Roth IRA, and there's nothing wrong with that. But we do want to start thinking about tactical, strategic distributions from those accounts when they can be most impactful. Maybe it's to optimize for premium tax credit. Maybe it's to fund the new roof replacement or the new car or something like that. So those would be the four rules. Taxable accounts first, traditional retirement accounts second, delay Social Security, use Roth IRAs and HSAs strategically. And there are plenty of good diversions we can go off those paths. Just because those are the four introductory basic rules doesn't mean everybody needs to live by those to the dot to have good results in retirement. But those would be the first four rules of drawdown.
We hope you've enjoyed this episode of Catch Amplify. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So Jackie, we'll see our audience next time on Catch Amplify. Cheers.